Welcome to the Addition Financial's webinar, Mortgage Refinance and Home Equity 101. Our speakers tonight, Joe and Kathy, are sharing their expertise from our real estate department. Feel free to type your questions in the chat box and we will answer them during our Q&A session towards the end of the presentation. And now I will hand over the mic to our experts.
Hi, good evening. My name is Joseph Harrison and I am a loan officer at Addition Financial in the Lake Mary headquarters. And my job here is to work with members and help prepare them for the process, whether they're buying or refinancing their home, and help them navigate any roadblocks they might encounter. As we go to the next slide here, we'll be discussing today's topics. We'll be looking at refinance options, home equity options. We'll be looking at which option is the best and comparing the two. We'll be reviewing available products, what to expect, and lastly, credit scores and appraisals. So to start, the steps to refinancing and home equity options. The first thing that you'll want to do is to consider your goals and what you're looking to do when you do a refinance or take out equity. You may be looking to do some debt consolidation. You may be looking to take advantage of the high value in the market currently to do some debt consolidation or add an addition to your home. Maybe you want to drop some private mortgage insurance that you had when you took out the property. There's a lot of different things you can do, and we'll talk about those. Next, what you'll want to do once you've clarified your goals is to shop rates and products. You'll be wanting to look to see what's going to get you to your goal and what's going to be the least expensive option for you. You'll want to check the rates and shop around and see what kind of closing costs those might entail. Your third step is once you've determined your goal and you've found the product you're looking for, you'll want to submit an application through the lender that you have chosen. You can do that online in a branch or over the phone. And then you'll want to be responsive to your lender. So during this time, it's not a good time to go on vacation. Even though you're not purchasing a home and there's a little less involved in this transaction, you still want to be available because you will have to have most likely an appraisal done and will need to be in response with your lender to turn in documents and make sure that you get everything in so that you can close the loan on time. Leads us to our next slide, as it does take time to do a refinance or to take out an equity loan. These are not simple transactions like closing on an auto loan or a personal loan. There is more steps involved due to the nature of real estate. So to begin the process, first you'll want to shop different lenders. You'll want to compare different products from lender to lender and see who's offering the better rates and what kind of closing costs those options have. Knowing your options is going to help you here. Then once you've done that, you can submit the application. And all during this time, you'll want to consider who you trust, whether that is your primary financial institution or some other banks that you have relationships with. You'll want to shop around and look for what's best for you. When you are refinancing your residence, you do have a couple of different options. You can do a balance only, in which case you would be looking just mainly to bring over the principal balance of your mortgage. Maybe you're looking to drop some private mortgage insurance or get a lower rate. When you're doing a cash out refinance, you're looking to bring your mortgage over, but also take out some equity, maybe for an addition or some debt consolidation purposes. With the balance only, you may be looking just to pay your loan off sooner and take advantage of lower rates, where with a cash out, you may be looking to do that in addition, take care of some other things.
And also with a cash out, this is Kathy, another loan officer here at Addition Financial. Cash out can also be done if you are lucky enough to own your home free and clear, and maybe you now want to put that to use for you to obtain cash out. It also can include your closing costs, and it's all going to be based, of course, on the equity in your home, and of course, the affordability for you based on your credit and income. And now we're going to our home equity options. Again, I'm Kathy Michaels. I'm one of the loan officers here at Addition Financial Credit Union. We offer home equity line of credits, which are typically your variable rate. They offer flexible use and reuse throughout a 20-year period. We do not offer at this time an interest-only option. I know that's a pretty common question we receive. We have no annual fee on our home equity line of credits, and we have no minimum initial advance requirements. Home equity is another very inexpensive way because we cover up to $1,000 of the closing costs here. So it's a nice way to tap into the equity you may have in your home. We offer them on a primary residence and second vacation homes. We also offer a first lien home equity line of credit, which would be on a home that you own free and clear with no other mortgages on the property. For those that maybe want the security of a fixed rate, fixed term, second mortgage, we have those. They're more like an installment loan. They're once and done. You have your 5, 10, or 15-year terms. Interest rates are tiered depending on the value, the percentage of value that you're borrowing. They're very competitive rates, certainly a much less expensive way interest rate-wise than possibly a personal loan or using some credit cards. But on both of those types of loans, we do cover up to $1,000 of the closing costs, which many times can cover a loan somewhere close to $70,000, $80,000. Now, when deciding whether or not you want to refinance versus taking an equity loan, again, goals have to be considered, both short-term, long-term, the dollar amount that you're looking to acquire. So, what is your goal? Is it something short-term that you want to be paid off quickly? Do you want to use your first mortgage, refinance, but maybe you have a really good rate on your first mortgage and you don't want to lose that? Then using a home equity loan may be the answer. How long you're going to live in the property is certainly factors in, because if there are going to be closing costs on a refinance, you want to make sure that is it going to be worth it? Maybe you'll be relocating in a year or two, due to personal reasons or through your employment, and maybe refinancing, even though the rate might be a little bit lower, when you factor in the costs, it may not be cost effective. Cash flow or debt free, again, many reasons to use the equity in your home. And depending on the term, you don't want to just use it frivolously, let's say, but it is certainly there to use. Right now, the rates are super low. The costs on many of our products are also very affordable. As a credit union, our fees are always very competitive. We are exempt from intangible tax, which can save you money as well. And is your income changing in the near future? So many times people will refinance their loans. Maybe they're preparing for retirement and they want to maybe minimize their payment because their income might be reduced in the future. Maybe they want to refinance into a shorter term because they want to get it done in a quicker manner. Maybe they have 20 years left and they're saying, I'd like to get this done in 10 years. I have education costs coming up, and this way, if I can get this out of the way. So there's many different reasons. So having all these factors in place when you're trying to determine what's going to be best for you, and when you give us a call or you visit one of our branches, certainly helps us give you your options so that you can make a good choice. And then there are some times where you're going to refinance and you're also going to go to home equity with us, because sometimes you'll have that refinance done, but having a home equity as a backup plan is a good thing to do. Some of our products that we offer here, we have, of course, our fixed rate conventional mortgages. We have our fast track mortgage, which I affectionately call our kind of little hybrid. It is a first lien mortgage on a primary residence. It's typically used on those that maybe they're used to paying their taxes and insurances on their own. We don't escrow for them. It is a lower cost alternative to possibly a conventional mortgage. We only offer a 5 or 10-year term. So that's why we call it a fast track. It's for those that want to get their mortgages paid off in a quick manner because their goals for the future are to be mortgage free. We pay toward $250 towards the cost, but again, they're minimalized costs. We do not escrow, and it's, as I said, lower than a conventional refinance. Home equity loans, we covered those, fixed and line of credit. One has the security of a fixed rate, one has the flexibility. Our low closing cost is a conventional mortgage where Addition Financial pays up to $5,000, 1.5% of the loan amount towards your closing costs. So for those that maybe the equity is a little bit tight, or if using it for a purchase, it is an option to minimize your costs and increase the cash flow or net equity that you may receive from your loan. We also offer jumbo mortgages, and that means when you're borrowing anything over $484,350. It's an odd amount and it changes every year or so, but that's what determines what's jumbo. And we're very competitive with that. We have fixed rate, fixed terms on those as well.
Great. Thank you, Kathy. So as we go through here, I'm sure you're probably wondering what you can expect during the process. So when our members call in and they have questions about applying for a mortgage, they really want to know if it's going to be worth their while before they submit that application and have their credit pulled. Unfortunately, we can't make any type of judgment about your credit score or anything like that without actually having that application and running it. And just so that you are aware, if you are applying with multiple lenders, if it's for the same purpose, you're doing a refinance application with us and then maybe a couple other credit unions to compare, that's only going to count against your credit one time. So you may be concerned that having these multiple inquiries is going to affect you, but it's really, in theory, not supposed to. So what you can expect when you're applying is your lender will be in touch with you. They will let you know what supporting documents they're going to need to proceed with your request. They're going to prepare you for the rest of the process, and you should be prepared to be in contact with them as well. Within 3 business days, if you're doing a fixed end mortgage, you'll be provided with an official loan estimate that is going to give you a breakdown of all of the closing costs associated with the refinance or the equity loan. And it's also going to give you a breakdown of the principal and interest as well. So what you can do is, if you are shopping with different credit unions and different lenders, you can compare those apples to apples. It's going to be very uniform and easy to make that comparison to help you make a decision. And if you are shopping around, it's okay to be upfront about that and let us know that you are comparing different lenders. We do encourage you to do what's best for you. Some things that you'll want to be prepared to turn in include your income documentation. If you are a W-2 worker, you'll want to be prepared to have all your employment information ready for the last couple years. If you've changed jobs, it's a good idea to have your address and phone number for each of those employers and what your salary was. Have your W-2s ready for the last 2 years. Have your recent month's pay stubs ready. Gathering your homeowner's insurance declaration page, we'll need a copy of that to move forward. If you're self-employed, there'll be some additional documentation that we'll need as well, including tax returns. But your lender, once they've taken your application, they'll give you a list of everything that you need to provide. Next, we'll be talking about credit scores and appraisals. As you're considering your refinancing and your home equity goals, it's a good idea to maybe access the MLS, which you can do through us. We have a service called C Realty Home Advantage. And by registering for the MLS, you can search homes in your neighborhood to see what comparable homes have sold for, to give you an idea of maybe where your value is. With that information, you can get an idea of potentially how much equity you have available to you. Of course, having your credit score, knowing your credit history before you apply will prepare you to answer if there have been any difficulties, to let you know just kind of where you stand. It's a good idea just to know what's on there before you continue, so there's no surprises. Another thing that will factor into some of the underwriting when we do these loans is, of course, the appraisal. And depending on the product that you're ordering, there may be some different costs involved with that, as well as whether or not somebody needs to actually visit your property.
So credit scores. Credit scores condense the borrower's credit history and payment patterns with the heaviest emphasis on the last 24 months. They consider numerous factors such as the following. So this is the percentages or the weights of each area that comprise your credit scores. Payment history, of course, being the utmost importance. The amount owed, And of course, they're looking the balances, say on a credit card, in relationship to the limit of that credit card. So if you happen to have a $5,000 limit on a credit card, once you start to exceed, some will say 30% of that limit. Typically, if you don't exceed that 50% mark of the limit, that's when you're going to start to see a dip in scores. So if you're always at the limit of your credit cards, try to get them paid down some, and you'll see a vast improvement in your score. Length of credit history is so important. I'm fond of saying that, I don't want to give away my age, but I've owned one credit card for so many years now that I would never, ever close it. It was probably my first credit card, and that history is so important. So even if you don't use a card, keep it open. Don't close that history. Periodically use it. Maybe fill up your car with gas, go out for a bite to eat. You can pay it in full. As long as there's not an oppressive annual fee that you pay on it, don't close your oldest cards. Keep them open. Types of credit. You want to have a nice mix, which means secured versus unsecured versus revolving. So if you have an auto loan or lease, that's a more secured because it's secured by an auto. Credit cards are your revolving, and then installment loans such as personal loans would be a nice mix. So having a mix always helps, certainly. Having a mortgage and having that payment history established for some time is always going to give you your strongest credit history and your strongest scores. New credit, we all have to open new credit periodically, but you don't want to do it too often or too many at one time. So periodically, if you feel the need for either a new auto, a new credit card, something comes by, you're getting appliances or furniture, it's not bad to do those things, but you just don't want to have too many in a short period of time because it can have a little impact on your credit score. The next slide, of course, goes into those same items that I just discussed. It shows the different questions that you can ask yourself when you're evaluating your credit. I know there's a lot of credit monitoring services out there. And, sometimes they give you a score which may not be quite what we will see when we run a tri-merge residential credit report. There's different credit score cards that they use when they're determining credit scores. And many times they're used to drive the consumer market, the ones that are going to possibly open up a retail credit card. Or they're going to be looking for auto loans. So what you may get in a credit monitoring service isn't always going to be what we're going to see when we run all three bureaus in a tri-merge report. So these are the questions you can ask yourself when you're trying to evaluate your credit profile before we actually submit an application. And I'll turn this over to Joe now with what we consider the different tiers.
Okay, so when we look at credit scores, of course, the higher the credit score, the more favorable the terms that you receive may be. One thing that I would like to say here is in regards to excellent credit, anything 760 and above that is considered excellent. A lot of people strive to get to that 850 credit score, so they sometimes consider adding another unsecured loan in there, or they try to add more debt to try to build that up. That's really not necessary when you get to that point, because once you're past the 760, you're pretty much going to be receiving the same terms as somebody who has that 850 credit score. We look at these different tiers. Certain products and guidelines will fall into these brackets. As you see, as you get lower and you have some credit difficulties, because we are a credit union, we do want to try to offer as much assistance as possible. So we do have a referral partner that can handle some of the credit challenges in some cases, called AmeriQ. And they are a company that we work very closely with, and they're very carefully vetted, that can actually offer FHA and some other programs that we're unable to offer here in-house. So even if you are unable to potentially qualify for conventional products with us, we do want to look out for your best interests, and we have resources available for you. Back to the credit scores, Kathy has covered a lot of these with her tips. As we look through these, making 100% of your payments on time, payment history is very big in maintaining good credit. paying those balances off every month. When you go to apply for a mortgage, we are going to look at what balance is reporting on your credit report, and that can affect your overall income utilization for qualification. So if you have these balances, that can affect potentially what you may qualify for, or you may have to have that paid off as a condition to move forward. Keeping your utilization low and avoiding opening too many credit cards or loans all at once. When you start to open lots of different products, or you have different inquiries for different things, that can drop your score more substantially because it's different things. So that looks riskier to the credit bureaus. Keeping those accounts opened and not closing your $0 balance accounts, that's important to have that long history, especially like Kathy said earlier, if you don't have an annual fee, why get rid of that history? And that also ties in with diversifying your credit portfolio, having a good mix of unsecured debt with having that mortgage debt and those auto loans. That looks more favorable to maybe somebody that only has a lot of credit cards. Checking your credit report annually, you are entitled to a free credit report from each of the credit bureaus. And what we like to recommend is just pulling one every 3 months. That's a good way to help you monitor potential fraud, or if something reported incorrectly, you'll be forearmed before you go and apply for a mortgage or refinance, and you can deal with that ahead of time. Knowing your terms and using your cards for emergencies only, just using your credit responsibly is going to help keep that score up there.
But also remember that if you do have some credit card balances and maybe you're at higher interest rates, we have a great balance transfer program here to our Addition Financial credit cards. And we don't have balance transfer fees, which is very unusual in that type of a situation. So
and
keep
no
us in
annual
mind.
Fees.
Yeah, no annual fees too.
Yeah, it's a win-win.
Win-win.
And then, of course, here we have the different bureaus here. The 3 major bureaus are Equifax, Experian, and TransUnion. When we do a refinance on your first mortgage, we do look at all 3 bureaus because that's going to give you a complete credit file. When we look at our equity loans, we pull Equifax. So if you do have some credit freezes out there, if you've had fraud in the past, it's a good idea to contact those before you apply for the mortgage so that we can start processing your request right away, and we don't have to wait for you to unfreeze your credit.
So some common terms and acronyms used and confused in mortgage lending. Every lender has their acronyms for some of their products possibly, and we try not to use those too often because we don't want people to get confused. But what you will hear is comps or comparable sales, and that usually comes into play when it comes to appraisals. When we're doing loans here, any conventional loan, whether it's a purchase, refinance with cash out, and some of our home equity products, we're going to sometimes need to, well, on the refis definitely, but sometimes on the home equities, do a full appraisal, which means an appraiser, state licensed, is going to come out to your home. They're going to take exterior pictures, interior pictures, measurements. They'll probably ask you some basic questions with regards to the age of your roof, etc. Then they start compiling this information in a report, which includes comparable sales in your immediate area. If there's nothing recent, then they just go out geographically in radius to find things that are as close to possible as your home. And then they make adjustments for differences in square footage, pools, different amenities your home may or may not have. The good faith estimate, or GFE, has gone goodbye. It's now known as the loan estimate, or the LE. Once upon a time, there was the good faith estimate and the truth in lending, and now they're basically combined into the loan estimate. The HUD settlement statement is at the end when you close, and it gives a detail of all the costs and with the disbursements. Same with that closing disclosure, or CD. These are things that come at the end of your loan. The closing disclosure goes out to you prior to closing for your review, and you have to acknowledge that so that we can then go to closing with the title company or the closing agent. The 3-day waiting period or rescission period. So when you're on a primary residence, when you're refinancing or taking a home equity loan, let's say your closing date is on a Monday. We have to, by law, wait 3 business days. Some people call it the cooling off period, but it's the right of rescission. And during that period, and this is just on refinancing and home equities, not on purchase, you have the right to cancel for any reason. If not, on the 4th business day is when that loan actually gets funded and the loans start to get dispersed. The homestead law, spousal acknowledgement of mortgage property for primary residence in Florida. Many times people have purchased their homes prior to marriage, and then once they become married, that partner, that spouse, has ownership through marriage if it is their primary residence. So even if they're not on the title or the deed, they are going to be required to sign the mortgage document at closing for a refinance or home equity loan. Unfortunately, sometimes people are in the process of dissolving their marriages. And again, until that marriage is dissolved, they are still required to sign. So sometimes with personal situations, it is easier to discuss it with your lender. Give us a call. We'll certainly give you the best advice we can, not legally, but what's going to be the most practical maybe for you. And along with your legal representation, then determine when is the best time then to move forward with your mortgage loan. Inspections. Sometimes people say inspection. Well, some people call the appraisal an inspection when the appraiser goes there. Some people call the home inspection. So when you're purchasing a home, you will sometimes hire a company to do a home inspection. Also termite inspections and all. So their inspection can be used 2 different ways. If you're having insurance claim work done, sometimes an inspector has to be done with that in order to get the claim money settled and released to you. So inspection can be used in various ways. So if you're unsure, please ask, just clarify. This way you're not confused. The survey, when we're asking about a survey, it is typically with regards to the boundary survey. So when you purchased your home, single family homes, townhomes, you get for lack of a better description, it's almost a bird's eye view, an outline sketch of your boundaries, your property lines, your home, your garage, if there's a permanent shed, anything that's of a permanent nature on your property. They don't put pictures of trees or bird baths or anything fun, but pools, anything that's permanent, that's your boundary survey. And we'll ask for that because it could possibly save you some money in your closing costs. The appraisal is, as I mentioned before, a full appraisal be done. There are some instances on our home equity products where we can do maybe an electronic or an automated evaluation, and then appraiser doesn't have to go to your home. But there's different parameters for that, depending on the percentage of value that you're looking to borrow. Title insurance and owner's title policy. Many times when we're requesting these or people have them on their loan, it gets a little confusing. So when you first purchased your home, there were 2 policies. There was an owner title policy that was mailed to you shortly after when you purchased your home. And then the lender that lent you the money on your purchase received a lender's policy. So then down the road, you decide you're going to do a refinance maybe. At that point, one of the things on the checklist we're going to ask you for is a copy of that owner's title policy. And the reason we ask for it is it's going to help reduce, not eliminate, the new title insurance that has to be issued for the new loan. So anything we can do to help save in your closing costs, we're certainly going to ask you for. And we're getting towards the question and answer period. We have a little quote here for you. Believe you can and you are halfway there by Theodore Roosevelt. So believing that you can do some refinancing, home equity, using your home to your best advantage, believing you can do that, you are halfway there, and we're going to help you get the rest of the way.
We're going to have a brief intermission to review the questions that have come in, and we'll be back in just a moment.
Hi, thanks everybody. We've gotten some great questions to come through. So let's real briefly, with regards to if your home is listed for sale, your home must be off the market when an appraiser goes out there. So if you're undecided, maybe you listed it for sale thinking, you know what, if I can sell it, we're going to move, but now you're undecided and now you're thinking, all right, let's refinance, let's expand, we'll stay where we are. Just please make sure your home is off the market and canceled and there's no for sale sign out front. So that was a good question. Another great question we received is with regards to when can the PMI, private mortgage insurance, be either removed from a loan or canceled. So with a refinance, if you're doing a refinance, as long as the new loan amount does not exceed 80% of the new appraised value, then there would be no private mortgage insurance. Another way is if you have a mortgage, a conventional mortgage with us or with any other lender, but I'm just going to discuss from our point of view. So if you have a mortgage with Addition Financial, and maybe you purchased it a couple years ago, and because the market has increased in value, you may be in a position to have an appraisal done at your expense. Typical expense for a primary single residence is $450, but the parameters are this. If it's between 2 and 5 years that you've had your mortgage, the appraisal has to come in high enough that your principal balance is 75% or less in order for the private mortgage insurance to be considered for removal. There must also be a proper payment history over the life of the loan as well, so that'll be evaluated. Once you've had the home more than 5 years or the loan more than 5 years with private mortgage insurance, and again with a proper payment history, a new appraisal, then you could be at 80%. But if you're unsure when you closed on your mortgage, you did get a disclosure with regard to these terms about private mortgage insurance. Or please call us or visit our branch, speak with somebody in our servicing area. Everything at Addition Financial is in-house. That's from application with your loan officers to your processors, your underwriters, and our servicing team. Everything is kept in-house. With regards to a balance-only refi, of course, you can include closing costs. You can also receive a nominal amount of cash out. And when I say nominal amount, it's typically $2,000 or 1% of the loan amount, whichever is greater. So if there's a little bit of cash out, maybe you only need $1,000 or $2,000, maybe for some small yard project or household project. It might still be considered a balance refi, and that helps minimize the closing costs. We got another question with regards to student loans and how that might impact a mortgage application. So student loans that are in deferment, the rule of thumb right now, and this has changed back and forth over the years, is if there is no payment showing on the credit report, whether it's $10 or $100, if there is no payment showing, we have to use 0.5% of the balance as your monthly payment. Sometimes it can cause the debt to income ratios to go over what we can possibly lend at. But again, these are questions that you can certainly call us. We're here. There's 6 real estate loan officers here, and all of us or most of us are usually available for your questions or your specific scenarios, and we can help you muddle through that. Another great question, medical collections, the scorn of everybody. On a personal level, we all wish that they would go away, that they wouldn't show on credit reports. Most medical collections, I'm sure, are not as a result of people wanting them to be there. They do, unfortunately, hurt your credit score most times, especially if they're recent. However, from a lender's point of view, I don't want to say we ignore them, but we don't typically require them to be paid, satisfied, because we know those were usually beyond your control circumstances. But unfortunately, the reality is they still do sometimes hurt credit scores, which may put you in a different tier on certain loan products. Somebody asked about refinancing cash out of the state of Florida. While we are in 22 counties of Florida, and it's a pretty darn big state, unfortunately at this time we are not chartered to lend outside of the state of Florida. Another question, our home equities, no annual fee. That's correct. We do not have an annual fee on our home equity line of credit. Our home equity line of credit is a product that has a 20-year draw period. In case you stay in your home that long, that's not typical these days, but it has a 20-year draw period. When you do advance it, we calculate your payments based on a 15-year repayment term, and they are principal and interest payments. Well, I want to thank everybody that attended and tuned in. Again, this is Kathy and Joe, my partner here. We're here for your questions. Please dial us direct. You see our contact information up there. We're welcome to any questions, to go over specific scenarios with you, maybe run some quotes and give you some ideas. But I thank you all for joining us tonight.
This concludes our presentation tonight. Stay tuned for an email containing a link to the recording of this webinar. Thank you again and have a great night.